Perfect. Good morning, everyone. Thank you so much for coming to my presentation. So I'm going to be talking about reimagining neobank fee structures. My name is Saira Rahman, and I'm the VP of New Investor Initiatives at Fundrise. So 10 years ago, we were promised somewhat of a revolution, right? The banks were old, there was no good technology there, net promoter scores are taking a huge hit, and the vast majority of millennials wanted to bank with something that felt a whole lot more like Google than what felt like their traditional bank. So we're promised this great unbundling, and in walks a bunch of different fintech companies. And I think back to some of the entities that came out way back in the day. I think about places like Lending Club and Prosper that reinvented the consumer lending space, OnDeck and CircleUp that were the new small business lenders, Motiv and Acorns that supposedly redesigned stock investing. And when I started thinking deeper about each of these individual sets of new fintech companies, I felt like there were different sets of hype cycles, and I want to go way back in time, so I feel like people think fintech really started to emerge in the last few years, and there's some of you in the room that have been doing this for like 15 or 20 years that know a lot more about what I'm talking about, which the original hype cycle was kind of closer to P2P lending, which if you're familiar with P2P lending, it was actually much closer to peer-to-bank. Then on the tail end of that S-curve, you see another emergence, and on this one, you see marketplace lending, which was this new innovative way of being able to source different types of loans for a person, but it was really, instead of being a marketplace, really just peer to another type of bank. And then over the course of the last 5 to 7 years, I'll call it, excluding the fact that there were a handful that started well before then, you see this new emergence, which is a hype cycle of neobanks. And neobanks were this digitally superior experience that consumers and businesses could have, but they were all backed by your local sponsor bank. I want to stop for a second and just caveat that I'm not talking about business banks. What I am known for and my background is specifically tied to consumer neobanking, so I'm going to focus on that. I do think that there's some adjacent ideas between business and consumer banking, but this is kind of where I'd like to kick off. So the idea is pretty straightforward. The people that are building neobanks have this general idea that they need to become what I'm going to call a super app, what I think a lot of people call super apps. And what it does is it consolidates all of your wallet. So checking, savings, investing, retirement, anything you can think of that your money is holding, it's compiled into one super app that you can easily source within your phone. And there are a bunch of different steps that I think that most of the neobanks are taking in order to achieve becoming that super app. The first step is raising a whole bunch of money. So a lot of these neobanks are starting VC-backed, and they're turning to their VCs and saying, hey, I would really like to start a neobank. I think I have this great idea. I'm targeting a specific niche of customers. Here's what I'd like to do. Once they raise a bunch of money, they go out and then they rent a charter. So they're turning to some type of a banking entity, whether it's a smaller sponsor bank or one of the more popular ones, and they're purchasing access to their balance sheet. Step 3 is that they start building one of those programs. So they select a product, depending on which side of the balance sheet they'd like to start on. So they either choose a lending product or they choose a deposit product, and they start building it out. In step 4, they end up having to turn back to the VCs for more money because they need slightly more time, the product needs to be refined, they'd like to launch a new product, they're trying to capture the whole wallet. You guys catch my drift. And by that point, you reach the next phase, which I'm going to call step 5, which is where you start to become so large because you have such a large suite of products that you become a super app. I think it's this interesting idea that toes the line between an actual fintech company and becoming a bank. And in my head, the question that keeps occurring is this a feasible long-term business model? From my perspective, I really think that in order to lower the cost of the overhead of acquiring a charter takes so much time that you might end up losing a lot of the innovation that you end up attempting to build in the first place. Simultaneously, while these super apps are being built, by the way, all of the incumbent banks are starting to duplicate the exact technology that the neobanks are curating. So you simultaneously had this new level of competition between traditional finance and the neobank world. My mind immediately goes to places like Wealthfront and Betterment, who went into this chase against each other to be the next best robo-advisory, and almost overnight, Charles Schwab comes in and takes over all of their customers. So where does that leave the SuperApp neobanks? To me, I think the issue is that all of these neobanks end up having the same exact infrastructure of a traditional bank underneath them. So because they have that same traditional neobank, they end up having the same misaligned incentives that led the customers to hate banks in the first place. So it ends up being this vicious cycle where they look and feel exactly like what they were claiming they were replacing. So to me, it feels like something we've seen before, but we're not quite sure what we're looking at. So let's discuss why you're here, which is to discuss the underlying infrastructure of a neobank and how that translates into fees for the customer. I want to talk about horizontal versus vertical building. Generally, in order to get the full customer relationship, you have to build out horizontally. And by that I mean most neobanks start with, like I said, either a deposit or a lending product, and they start initiating additional products as they see some success and gain traction within one individual product line. The thesis is fully dependent on being able to build one of each product. I personally come from a finance background. To those of you that know me, I was the former head of finance at a neobank. And to me, I think the unit economics get very difficult the second you have to interface with an actual bank. So you can get very close to break even, but once you have that intermediary, it's really, really hard to achieve a break even without some form of VC subsidy in addition to keep you alive. So my hypothesis is that we should be building vertically. By that I mean we start knocking out the middlemen, and in that scenario, the customer gets the most ideal structure because no one's holding the neobank hostage to typical fee schedules that the bank is already forcing upon the neobank. So the infrastructure at that point can then be reimagined to align better for the customer. So this is kind of what I've been thinking over the course of the last several years, which is how the structures and incentives within the financial industry today are built. And because this is something I've been thinking about a lot, I want to play a game with everyone in the room. But while we're playing the game, I think the question that I want everyone to answer is what in the financial industry's incentives enhances the customer experience rather than taking away. So we're going to play a game where I flip a hypothetical coin. And when I flip that hypothetical coin, we're going to bet all of your parents' savings. And if it's heads, we both win. But I get to keep 20% of that gain. And if it's tails, your parents lose everything. Cool? Everybody's tracking? Awesome, great. First coin flip. Amazing, it's heads. Everybody wins, I get to take a little slice of it, but your parents are happy, so who cares? Second coin flip. Amazing, still heads. I'm pretty good at flipping a coin, so you guys are doing great, I'm doing great. We're gonna continue on the game. Third coin flip. Everybody thinks I'm a genius. I'm really good at flipping this coin. Still making money for your parents, still making money for myself. Next coin flip. Unfortunately, it's tails. Your parents lose everything, but I get to walk away because I was getting paid to take on that risk. I don't know how many of you feel familiar with that idea, but it's how the investment industry happens to work. Every sector has a different name for what it's called. In the real estate industry, it's promote. If you're a VC, it's called carried interest. But it's the same concept. And it's heads, we both win, and tails, you lose. So I want to shift into something that some of you are probably familiar with. I want to take a look at Tiger Global, which is one of the largest hedge funds in the world. They were absolutely killing it in 2021. They were considered to be one of the darlings, I think, in the investment world. And last year, they took 20% of their gains from their LPs. And I guess what goes through my head is how much of their success was tied to them being these immaculate, amazing investors versus how much was part of a growing market and a great macro environment. So those of you that have been tracking Tiger, like I have, know that they're down 50% through the end of July. So it's officially a down year. The question is, since tech is also down, did they actually give back 20% of the profits that they took from the last however long when everything was up? So I want to go back to my original question, which is, how is the finance industry's incentives enhancing the customer's experience? Because this is one of those cases where there's a big gaping hole within the industry. I'm going to zoom out for a second, and this is something that I've kind of been charged with, which is really to build a better financial system for the end user, the customer. And my entire perspective is built around how to figure out rebuilding those incentives so that I'm actually aligned with the customer versus just taking money out of their pocket. So going back to the idea of a vertical and how to build on that vertical, I'm going to talk about the private equity industry, specifically as it pertains to real estate, since that's adjacent to Fundrise. But in this example, Anita, who's an individual, she's a teacher, she pays into a pension. The pension is then turning to a fund manager and saying, okay, Mrs. Fund Manager, can you please get me some return for my pension fund? The fund manager says, awesome, I can totally do that, turns around to a real estate operator and says, hey, can you find an asset that's going to generate some type of yield on behalf of my fund? The real estate operator says, yeah, absolutely, I'm totally happy to do that for you. Ends up purchasing, in this case, an asset. I think you guys know where I'm going with this, but in this case, the real estate operator takes 20% of the fees. The fund manager takes 20% plus their fees. And the pension ends up charging their own fees before handing back some small return to the end user. Nearly half of the return in this example is lost somewhere in the financial system. And those are in the scenarios where it works out. If anyone ever wants a really fun rabbit hole, feel free to take a look at the pension industry. It's in like a borderline state of crisis. But this goes back to the same idea where Anita ends up winning when the other entities win, but she ends up completely shortchanged in the scenario that they don't. So diving into the concept of vertical integration here within the financial industry, in order to understand the system, I think you have to look at the entire thing. So what exactly is a value chain? I'm going to use the example of a lipstick. So for a lipstick, somebody's going out, buying all of the chemicals for the lipstick, handing it to another company. Another company takes it, packages it up, hands it off to another company like MAC, for example. MAC then takes the lipstick that's in a tube, puts a nice wrapper on it, and sells it out to the consumer. All of these steps get the individual connected to whatever the asset is at the end of the chain. Using this value chain idea, I wanted to do a couple case studies to talk about places where the combination of consuming the full value chain compounded by the tech stack alters significantly what the end product ends up being. So first and foremost, you have this example, which is just places like Comcast and DirecTV turning to places like Disney in order to get more production entities to provide things like TV and movies. When you combine all of them, which is essentially just a B2B sales chain, you end up with things like Netflix, which they're a combined technology platform that has a really cool algorithm that does a significantly better job targeting the consumer, compounded by the fact that they're able to combine all of the different segments within the value chain, compacts the cost for the end user. So I think at one point I was paying like $50 for cable TV. Now we're down to like $15.99 for Netflix, and I get a significantly better user experience. Same concept, flipping to the automotive industry. In 1913, Ford was completely integrated. At one end, you had rubber and all of the different materials coming in. At the other end, you had an actual car going out. Over the course of the last century, the automotive industry got extremely specialized and separated into individual silos. So as that industry specialized, it became harder and harder for one individual player to move up or down the value chain. Once that value chain ends up getting set, it's extremely hard to disrupt. In walks Tesla. So you can probably see where I'm going with all of this. Going back to my original example where I was talking about real estate, specifically private equity, this industry was specialized 30 to 50 years ago, and none of those individual structures were built such that they needed to start innovating. They're all making tons of money, and they're doing well without the customer. So this probably makes sense to everyone now, but now you have a compacted app inside of your phone that has all of the stages of private equity inside of that app, and a significantly better return to the end user or the customer comes in the form of Fundrise. So let's apply it all the way back to the original idea. Now that we've stepped through a bunch of different examples of places where vertical integration compounded by a positive technological influence, do you still think that neobanks need to build horizontally instead of vertically? I think it's important to address exactly how a bank/neobank makes money. So before I step through that value chain, it's worth discussing this aspect. Banks make money, and most neobanks make money as well, by starting off with lending to a customer, and then the difference between where they lend and where they're able to pay out their customers on deposits, that difference ends up being called the net interest margin. It's the technical term for that, the revenue that they make on that piece of their income. The second piece that I think is slightly more nuanced and perhaps more interesting is the fee structure. The cool part about neobanks and what they deserve applause for is that they did come in and disrupt how banks charge fees. So they found the egregious fees and said, we no longer want to charge these, we're getting rid of some of them. And I think that that's great. The thing that I don't love when you look at these two lists is twofold. First, that some of these fees got rebranded rather than actually changed. And second, that a lot of these fees are identical. I think the one thing that's really interesting that's at the bottom of the list for banks, which I find to be a huge conflict of interest, is that sponsor banks have to get paid by the neobanks in order for them to get access to their balance sheet. Well, to me, if you think about it, that ends up being a problem for the customer, because the customer now has this intermediary and these additional costs that are likely going to be pushed onto them if you're a neobank. Okay, so let's step through my little example on the value chain. So we have Zach, who loves his fintech app, and Zach is taking his money and depositing it into his fintech app. The fintech app is using a bank in order to be able to offer Zach his deposits. That bank is then turning around, and in my example, they're purchasing loans from a different fintech company. And that fintech company is essentially providing them with the asset, which is the funding and the cash that goes onto their balance sheet. I've clearly oversimplified this process, by the way, but the concept is the exact same, because the lender ends up taking a piece of their loan portfolio before handing off whatever they'd like to the bank. And the bank is saying, I'm so happy that I made a net interest margin, I'm going to turn around and give the fintech company the remainers. And the neobank then says, okay, cool, I now can calculate what APY I'm willing to offer out to my customer, which ends up being significantly smaller than what you would have had if this wasn't one big transaction that had multiple players involved. So I'm reviewing the neobank value chain, and I think it's way too expensive from different angles. To me, what fascinates me about the fintech value chain generally is that it's actually coming from both sides. So depending on which side of the balance sheet you're on, you're interacting with a bank still in the middle, but you're still facing the exact same problem. And because of that great unbundling that occurred, that's what created this problem to begin with. You have all of these separated entities that all have to interact with the bank. So you end up being stuck with all of these expenses, and too many people want a slice of that pie before it gets back to the consumer. So in my head, I'm thinking to myself, these expenses end up increasing over time, and I haven't figured out what the solution is. Well, a lot of people say there are lots of people that have become, or lots of entities that have become super apps. They take the jump to being a bank, whether they decide that they want to acquire a charter or whether they decide that they want to acquire an actual bank. And that banking charter really finalizes that metamorphosis of neobank to traditional bank. I have lots of thoughts surrounding this. The first and most prevalent is that when you review a lot of these entities, they're struggling financially. That overhead of the required regulations, compounded by the fact that you now have to pay for this actual charter, essentially creates enormous expenses that you don't really see in traditional finance. And then it goes back to this idea of VC money. So are you going to have to go back and raise again in order to sustain your bank charter? Second, the other piece that I think is actually more critical than the financial aspect, I don't know how many of you have attempted to wander through the products that are offered through some of these super apps, but I haven't seen any innovation. None of these are remarkable to me in terms of having integrated by purchasing a bank charter. It feels a whole lot like one of my favorite clips that has to do with one of my favorite TV shows, so if you don't mind indulging me.
On baseball quiz shows, terrorism and media is vertical integration.
What's vertical integration?
Imagine that your favorite corn chip manufacturer also owned the #1 diarrhea medication.
That'd be great, because then they could put a little sample of the medicine in each bag.
Keep thinking.
Except then they might be tempted to make the corn chips give you...
Vertical integration.
Wow, that should not be allowed to happen.
But it's my job to make sure that it does happen.
So glad I got a laugh out of this one. So I think for me personally, the most remarkable thing about neobanks is that once they become banks, they become equally as unremarkable. There's no innovation. So back to the original question. This time I want to talk about what the ideal financial industry looks like. And I want to talk about the margin between lending and deposits and how to rehypothecate or take much more of that margin and give it back directly to the customer. And if I could rebuild the entire industry from the ground up, exactly what that looks like. So here's my final proposal. I want to skip the bank charter completely. I think that if you want to curate something brand new, you need to curate it without the bank charter. Figure out how to do it without a bank sponsor. And once you've figured out that individual line, so once you've built all the way down the tracks into that particular product, then you can move on to the next product line. And I think that's the only way that you can capture value and not be beholden to bank fees, because that is the problem to me within each individual product. So I think that begs the question that everyone's probably thinking, which is, okay, Saira, what are you talking about and what exactly does that mean? And in a hypothetical situation where I'm challenged with contemplating exactly what a world would look like without a bank sponsor, I would first and foremost figure out which regulated products have been in existence for the last 30, 40, 50 years within our financial industry that are generally underutilized but still extremely safe because they're highly regulated. Completely removing, I want to say this very specifically, I think a lot of people think I'm going to talk about crypto. I am not. And I want to think about how, from the customer's perspective, you don't want to charge per transaction. Sure, interchange is a thing. I don't think interchange is a sustainable revenue model, so you almost have to ignore that from the actual underlying product. But if you want your customer to not treat you as the neobank like a transaction, then you have to treat your customer like they don't need to be charged per transaction. And then I start thinking about hypothetical product ideas. So what if you had a savings account where you get to give the depositor the highest interest rate possible instead of having to compare it against your other product line and give them the leftovers? What if you built a credit card where you are rewarding your customer for carrying no balance or having the lowest balance instead of rewarding them for charging things to the card? Or what if you built a professionally managed alternative fund without any sales load or carried interest? Those are the kinds of things that go through my head. Obviously, I'm also contemplating how to do that with the safety of the customer in mind. And the reason for that is because at the end of the day, I really think the financial industry is just a big matchmaker. And the job for all of us is to connect the individual customer with the most productive use of capital, and then to layer the tech stack on top of it in order to lower the cost as close as possible to zero. So to that end, I'm happy to say that I still think there is an unbundling revolution going on. I just would argue that it's an ongoing battle that might not necessarily be inside of San Francisco. I would like to thank all of you for attending and listening to my presentation, and thank you to the sponsors as well, especially Moov for taking another gamble on me, and I'm happy to take any questions. Yes, hi yo.
Great job, and completely agree and align that there needs to be mass disruption. But fundamentally, when those neobanks go from this ideation and conceptualization, at some point you're met with regulation.
Yeah.
And that's what changes it and puts it back. To be able to do what you're suggesting, I think it has to take a complete shift in regulation. How do you think about that? Because fundamentally, rightly or wrongly, it's put in place to protect the customer.
Yeah.
And the reason that everybody starts looking the same is because they're all following the same rules and guidelines.
So I think if I wanted to break the regulations, I wouldn't utilize an actual bank account. I would do a synthetic style of bank account that's perhaps some type of, I don't know, money market funds pop into my mind. I think there are really interesting ways that you can curate products that aren't beholden to the same banking acts.
So you would eliminate the concept of the traditional checking?
Yes, but still make it feel like there's ACH, money transfer, peer-to-peer. All of those things can still exist, not within the confines of the bank account. Yeah. Oh, I love it when you guys go easy on me. Yes.
I think you described the challenge and some of the downsides to this model really well. I'm wondering if you'd spend maybe another minute describing some of the ways you could create returns for people without getting involved in that whole ecosystem of credit cards carrying balances being the rewarded activity, for example, since that's what generates the revenue for the issuer typically.
Yeah, so your question is, what ideas do I have that would actually solve the problem that I'm stating? So I have lots of ideas. I just don't know how much I'm allowed to say right now. So I was more alluding to them. But I think there are unique ways that you can flip the products on its head, where you absolutely still need an issuing bank, right? But that doesn't mean that I can't create a product around it that would shift based on my underlying infrastructure as an entity. So rather than formatting it in the same way, right, of the net interest margin between lending and on my trade lines and the underlying deposits, I think there's different ways you can incentivize it if you have different products in your product suite. I indirectly answered your question, and I apologize for being vague.
Thank you.
Curious what you think about the VC world incentivizing speed to market and iteration, and what it would take to build something that you're portraying here, where it's less like, it seems like it would take a lot of investment of thinking through how you want to build it and building everything from scratch versus when you wrap someone's APIs.
Yeah, so I think if I'm saying your question correctly, you're asking how I think through the VC piece for a neobank that wants to build from scratch.
I guess if the VC funding ultimately is going to put these products in market, and they're incentivizing speed to market and iteration, it seems that what you're portraying is more of a long-term vision. But how do those companies get to market in the first place when their competitors are just capitalizing on them?
So how do neobanks get to market quickly without launching a bunch of different products when the VCs are behind them? Is that what? Sorry, I don't know if I fully understand.
I think what you're outlining here is a much deeper build that could potentially never get to market if these companies need the VC funding that are going to incentivize quick product launches.
Yeah, so I hear what you're saying. I mean, I do think that if you're launching a neobank generally, it's going to take a minute. Like the amount of time to integrate into a Fiserv is, I don't know, 6 months lead time plus a year to integrate, right? Like, I mean, the build out of a neobank inherently requires a substantial subsidy on the front end. So you have to have quite a bit of VC money on the front end just to be able to get to your initial product launch. I think that there's a different, I guess my suggestion is that I think there's a different way of doing it, because if you're going to get a whole bunch of VC money on the front end anyways, there's probably potentially a faster way to do it, but I haven't tested that theory yet. But simultaneously, I think if you're going to build it out, there's a different way of going about it where you're not going to face the same level of regulatory issues towards the tail. Trevor.
Two questions for me, actually. The first one, you used Monzo as an example. You may have spotted from my accent that I'm not from around here. In the UK, they are both a neobank and a bank. They have a banking license, right?
Right.
And I've got maybe ignorance of the US banking system. To what extent is that possible in where we are now, whereby a neobank could become their own bank?
So there's a few entities. Your question is, what's the ease of which a neobank can become a bank? Yeah, so there's a bunch of different ways you can do it. There's a lot of entities, not a lot, there's a handful of entities that have been granted a fintech charter, which is where they just directly applied through the government to get a charter in order to be able to be essentially a fintech company that is a bank. The more recent popular way of seeing a lot of entities convert is they go out and they find ILCs, which is a specific type of bank charter, and they'll go out and they'll purchase it. Something that I ran into when I was kind of observing that segment of the industry is that almost every neobank is looking to buy a bank right now, which is interesting because it comes with its own set of headaches. But that's, yeah. Did that answer your question?
Absolutely. And then the second one, so to speak, is you touched on the fee structure, which does seem a little bit back-asswards to an observer. But there's also the operational costs. And one of the things we've seen, certainly in the UK and EMEA markets, is the cost of infrastructure. So having modern core banking systems that allow banks to iterate quickly, test new products, and they're not relying on some god-awful thing made in the 1970s, which, like I said, takes a minute to do anything in fintech. To what extent does that factor into your financial modelling? So actually it's a much lower overall operating cost, so it means the bank can maybe pass on more of the returns to the customer.
I mean, if we're talking from the neobank perspective, I think neobanks are charged with having to try the newer and the better technology, right? So neobanks that I've worked with, they integrate into Moov. They utilize the infrastructure that's newer. I think it's harder when you're at a traditional bank, which is also where I've worked in that space as well. And they all like Jack Henry. They all like traditional stuff. I think JP Morgan recently took the dive into Thought Machine, which is a very interesting product that I personally really like, but I think that's a lot more an edge case. It's not, it's an outlier. Most traditional banks like what they know and they know what they like, and those contracts are usually for 10 to 15 years, so they're very difficult to break and renegotiate. Yes?
Yeah. So what's your take on top 20 banks acquiring fintechs and earlier stage companies in the effort to grow beyond their branch footprints?
For sure. So question about fintechs getting acquired by banks. I think there's two problems. One is neobanks love to have revenue multiples that make them almost impossible to acquire. I think the second thing is there's going to be a significant correction. I saw something this morning that some of them are actually starting to get repriced pretty aggressively, which is good and bad depending on which seat you're in. But yeah, I think the next level of consolidation will hopefully be where neobanks get acquired by traditional finance. I just think it's going to take some time for those neobanks to come down to reality. Yeah. I'm a few minutes over, so we should probably cut it here. Thank you so much.